All right, the financial markets talked at the top of the hour about how the stock market was up. So you see the green across the screen, Dow, S&P, and NASDAQ. Jerome Powell, the Federal Reserve Chairman, strongly indicating interest rates cuts are coming, right? That's what he said in that Jackson Hole, Wyoming speech. So that's why you have the stock market back in rally mode today. Okay, let's talk about this a little bit as we bring in from Moody's, the noted economist, Mark Zandi. He's chief economist at Moody's Analytics. Okay, Mark, welcome back to the show. It's always good to see you. Just go through, I want to ask you a bunch of stuff here if I can, hopefully on economic plans. You and I talked about Trump before, and now Harris is outlining her plan. But what about Powell today and the significance of his statement and where interest rates go, not only in September, but in the foreseeable future? What's your outlook?
Good news. Fed's going to cut rates in September. I can't remember a time prior to a meeting where they've been so explicit about what they're going to do at the next meeting. He's going to cut rates. The committee's going to cut rates. And then I think cut rates steadily going forward. Probably be cautious at first, but right now, just to give you context, the federal funds rate target, that's the interest rate they control, is just under 5.5%. If you told me we're at 4 to 4.5% a year from now, that sounds about right to me. So that's moving in the right direction, and that really will help. Small businesses that borrow bank loans at a prime rate that's tied to the federal funds rate. It'll help low-income households who took on a lot of credit card debt when inflation was high. Consumer finance loans. It's even brought down mortgage rates a bit and auto loan rates, so that should help with vehicle sales and with home sales. So all good news. So
when Mark talks about being explicit, a lot of times, Fed speak, as people call it, is anything but explicit, and you have to figure it out. But Jay Powell today, Jackson Hole, here's how he put it and what he actually said about interest rates. Let's listen to Chairman Powell.
The time has come for policy to adjust. The direction of travel is clear, and the timing and pace of rate cuts will depend on incoming data, the evolving outlook, and the balance of risks. We will do everything we can to support a strong labor market as we make further progress toward price stability.
It's interesting that what he's referring to is what they always call data dependency, right? And the labor market, which he talked about, we had that piece of data this week going back where they revised down the job growth figures. So how is that factoring into things about what would you say to people when they say, well, how is the economy right now? What's your answer?
Good. It's good. I mean, unemployment is low, 4.3%. The economy, despite that revision to the data that you mentioned, is still very strong by historical standards. Inflation, as we just mentioned, is back down, very close to the Federal Reserve's target. Stock prices are at record highs. If you're lucky enough to own stock, 2/3 of Americans own their own home. Home values are at record highs. So it's not. It's you got to. I'm painting with a broad brush, and clearly, lower income households are under a lot of financial pressure because of the high interest rates and high inflation that they're struggling with. Broadly speaking, the economy is doing well. But having said that, I think the Federal Reserve recognizes, Chair Powell recognizes that if they keep their foot on the brake here too long, keep rates too high for too long, they could break something in the economy and in the job market. And he's saying, look, I don't want, the labor market is slowed. He would say, rebalanced. It's consistent with low inflation, but I don't want any further weakening.
Yep, they have that dual mandate, so they have to. It's not just inflation. The inflation under Biden chart is on my tablet, so I'll put that up, and then I want to shift gears. And again, when Mark says it, you'd rather be here under 3% than here when it peaked over 9%, right? When I say shift gears, here's the Harris-Walz economic plan, or a brief, bullet point summary of it. We talked last time or the time before that when you were on about Trump and the tariffs and what that would do to the economy. When she talks about child tax credits, the new housing units, in particular, I might want to focus a little bit on some of these things right here and right here. The $25,000 for first-time home buyers, the kind of going after price gouging. Tax on tips, Trump's obviously was for that too. What would the effect on the economy be, or have you started to do work on that, of the Harris economic plan if it were implemented?
Yeah, I think it's the status quo. I mean, I think it'd be consistent with the continued solid job growth, low unemployment, inflation, that we'd all feel comfortable with. I've got some bones to pick in the plan. There's a lot there, a lot of moving parts. So not too surprising. I wouldn't like everything.
Thanks so much for watching. Just go to joinnn.com to find NewsNation on your television provider. And don't forget to click the red subscribe button below to get more of NewsNation's fact-driven, unbiased coverage.